Hello, everybody. We are back. I'm Tom Sosnoff, and I'm here with my buddy Dylan Radigan. Mr. Radigan, how are you?
Very good. Nice to see you. Pleasure to be seeing you. Happy to be here.
Pleasure to be seeing you. I'm excited to be back. It's another Fed day right now. Wednesday, 1 p.m. It's May 3rd, and the S&Ps were up $12 when that's 12 handles. When the Fed news came up, they're up 12 handles right now. So initially they jumped and then they sold off a little bit. Now they're about pretty much unchanged, maybe down a couple ticks. So the Fed did what what everybody thought the Fed was going to do.
It was a classic example of meeting expectations and being a non-event, if there ever was such a thing.
Yeah, I mean, the CME Fed Watch tool had it about I think it was 86% chance yesterday afternoon of a quarter point raise. Quarter point raise it is. Everybody's happy. Okay, let's turn those machines back off. Let's crush all the premium. Let's make this thing into okay, Vol, do your duty. It was up a little, now it's down a little, but they haven't taken enough out yet. I need a little more.
Okay. I mean, so again, this is the least interesting topic, obviously, when these things happen. Now, the only thing that occurs to me this week with the raise and pause, which again meets expectations, but this is also the week that, in my opinion, with the First Republic JP Morgan deal, that the fate of regional banking, which was cast in 2008 or 2009, when they certified too big to fail, and they basically doomed the non too big to fail banks to go away, that this week was a major step in the consolidation of American banking to be 4 or 5 different banks. And I only bring that up because the Federal Reserve is partially responsible for that, although arguably it's the management at the regional banks, although arguably it's inherent advantage of the big banks. Let's assume the regional banks more or less go.
By the way, this is the opinion of Dylan Radigan. I do not agree.
No, this is the opinion of the stock market.
No, I do not agree with that.
So then why are all the regional bank stocks down 60 or 80%?
Because they exposed a fatal flaw in the regional stock, in how regional stocks manage their, how they manage their book.
I mean, so you don't think the fact that JP Morgan has a different classification gives them an advantage over a smaller bank?
No, I feel that the regional bank failures are, listen, you can't, if you have a series of failures that are all based on similar levels of incompetence at a management level, like an unwillingness to...
The same incompetence exists at JP Morgan, but JP Morgan, unlike First Republic, is not subject to it because of their liquidity and their access and all the...
They're not subject to it because on a relative basis, the amount of unrealized losses in JP Morgan is minuscule compared to the amount of money that they have assets under management or assets at the bank. So it's not apples to apples, but it's not apples to apples. It's not that they're too big.
But the one is the giant banks have a massive structural advantage over anybody who's not a giant bank.
Well, giant banks,
the end of small banks.
Giant banks have a structural advantage everywhere in the world. But yes, if there was no opportunity, then the entire there has been I've never had any interest in the banking space, so I can't speak as a banking entrepreneur, but there's been an entire movement over the last 12, 13 years of challenger banks that did have an opportunity to capitalize on disrupting traditional banking. And there's also been an incredible movement, with regional banks actually missing the entire move because they got so happy with the drop in interest rates that they were making money that they didn't realize how much risk they were taking in the process of making money all along. And so they didn't innovate. But I don't put that on the big banks. I think the big banks have their own series of flaws in their mechanics and in the foundation of those banks, but it's a different animal. Like I can't compare JP Morgan to some regional bank.
Of course, but what I guess what I'm getting at, and then I know this is the point of view of Jamie Dimon going back to the 90s, other countries don't have the hundreds of banks. It's a
No,
waste.
you're right. Other countries like Canada have, 6 banks. Australia,
or the Santander is the bank in Spain.
Yeah,
BNP Paribas, the bank in France. And so I know there is a philosophical point of view with the big lawyers and bankers in New York that all of these American regional banks are a total inefficiency. And we should be like every other country in the world and have, 2-5 banks that run everything. And thus the M&A wave in the 90s, thus the move to consolidate in 08 and 09.
So should we have 2 or 4 brokers? I mean,
I'm just saying that whether it's good or bad is a different discussion.
I know, but should we have 2 or 4 car companies? Should we have 2 or 4? I mean,
we do have 2 or 4 car companies.
The problem with that is if that was true, then you never would have Tasty. You never would have had Thinkorswim. You never would have had Tesla. I mean, if those were really true, none of those would. So no, I don't buy.
Well, it does not prove anything in the car space because that's the ultimate exception that proves the rule. But your point is innovation gets destroyed when you don't have more entities.
Right. But my point is, though, yeah, of course. But what I'm really saying is the fact that the banking industry, the regional banking industry is where the regional banking industry is not because there's not demand for regional banks. It's because of the incompetence that being displayed by the regional banks and their boards and their inability to move outside of their own little circle of uselessness. Like the concept of a regional bank, it's great. Nobody wants to be do their primary banking and everybody wants to be local. The problem with regional banks is that they haven't innovated, they don't have technology, and we haven't protected the integrity system by raising the FDIC minimums. That's the problem with regional banks.
Yeah, I mean, I disagree because I would say that the incompetence is not unique to the regional banks, but the incompetence is across the entire industry, whatever that incompetence may be, risk management, asset allocation, rates, etc. But that the larger banks are not punished for their incompetence. In fact, they are supported structurally to exploit the failures of the incompetence of others while pretending that they themselves don't have that same incompetence. It's again, if I'm playing soccer against a 5-year-old, I may be a terrible soccer player, but if I'm
sure,
3 times bigger, and so I actually look at it more as a policy decision, which is a policy decision was made after the financial crisis in 8 and 9, which really goes back to the 90s and its run up, which was we're going to have 3 or 4 banks like every other country. It's just going to take 10 or 15 years. And I would argue this week is a watershed of moment in the end of regional banks, which is not a way of disagreeing. Sure, they're incompetent or they fail to innovate or whatever it is. And they had a higher incentive to do something because if they didn't do something, they were going to get swallowed. The bigger issue, you're going to say, listen, the reason Spain doesn't innovate or the reason France doesn't innovate is because they're all, Santander or BNP Paribas or whatever the national bank of a given country is.
Well, I mean, Credit Suisse is an example of but that's an example of essentially a country with very few, with a bank that was too big to fail that failed.
Of course.
So it's not a guarantee. I mean, Deutsche Bank is another example of a bank that was too big to fail that failed. So you can't say that to me, if you looked at it at a level of the number of banks that are too big to fail, taking Credit Suisse and Deutsche Bank or whoever else, I don't even know all the other ones, into that equation, I would bet that the number of banks that are too big to fail on a statistical basis is probably, and that did fail, is probably greater than the number of regional banks that failed relative to the number of regional banks there are. So I think it's kind of like the statistics don't bear out that argument. Just as many banks that are too big to fail as compared to regional banks on a percentage basis. It's just there's 4,000 or 10,000 regional banks and 10 fail. Who cares?
Agreed. I don't care.
Right. I don't care either.
But if you're going to move to a world where the policy is to have 3 or 4 companies that control all the assets, I would say that my irritation, my frustration with the American model is I believe America would be much better served if the Treasury Secretary came out and said, we want to have 4 banks. We're not going to pretend, because they're like, well, we have this.
I know, that's ridiculous. I don't agree with that. That's ridiculous.
Well, no. It was because we have all these rules that pretend that we're a democracy or whatever the thing is, and that there's a net cap. Only 10% of assets can be held by any given bank. But then when you look under the hood, you're like, well, hang on a second. JP Morgan and Bank of America already have collectively 30% of the assets between the two of them, with a 15%. And when it came down to taking the PNC bid, which has 3% of assets, or the JP Morgan bid, which has 16% of the assets, they just waive the rules when it matters in order to ensure that the largest banks control more assets. So there's no debate that the policy is to make the large banks control the most assets.
I mean, that's easy because it fits into your story, but I think that when you look, if you probably, we weren't party to the terms of those deals, and my guess is that they went with the deal that protected that protected the integrity of the system the best and the quickest. So you don't know if those...
Sure, and going to the biggest bank is always going to be that. If the answer is, what is the least expensive, least risky decision here? It's always to give the assets to JP Morgan or Bank of America or UBS or whoever the biggest bank is.
Yeah, but that doesn't always work though. Like if I want a mortgage and I go to JP Morgan, I'm going to get... there's no way I'm getting a mortgage from JP Morgan because they stink. They're going to give me a crappy rate, a crappy mortgage. So I'm going to go to a regional bank, and that's where I'm going to go. And so, I mean, it's not always the best deal. I don't
think it's the best deal from the taxpayers, but in the bailout scenario, I would rather have JP Morgan absorb the assets than Dylan and Tom's regional bank.
Well, the problem in this case was that somebody had to have $30 billion in cash lying around. Like
only the largest banks have.
Right. So, I mean, but again...
That's the structural advantage.
I know.
Policy of big banks.
I know, but again, I just think we're just squeezing everything in to fit the narrative. That's all. I think that there's going to be enormous opportunity in the next decade or two for regional banks. And I think that if the only reason that somebody is buying JP Morgan, Bank of America, Morgan Stanley, Wells Fargo here, Citigroup, if the only reason somebody's buying those stocks is because they think that there's an advantage because they're too big to fail, then they're going to all go down in value. They've all topped out. If that's the reason that anybody's buying any of that stuff, then that's the only reason you're buying it, then there's no reason to buy it.
Have you bought or would you buy any of the regional banks in the context of this week's abomination?
Have I? No. But then again, I don't ever trade regional banks. So it's not like, you gotta remember, when you're an option trader, there are no regional banks to trade. You can't even trade the indexes. They're all too small. They don't really trade. Have we traded some of them just like for kicks and giggles? Sure. But do I really ever trade regional banks? I haven't traded regional banks in 40 years.
The reason this topic is interesting to me, which goes back to the discussion last week, is all this goes down to whether it's a small number of banks or a large number of banks or challenger banks or whatever the mechanism of the control of allocation of money is, that is the allocation of money that dictates so much of economic outcomes. And theoretically, a regional bank is a better asset allocator, very theoretically, relative to its region. And the small businesses that are in the manufacturing business and also they want to work with a banker that knows the thing. Or Silicon Valley Bank was a classic example where they understand the startup financing model and how to price the risk and all that sort of thing. And my concern is that we're moving more and more to a world where intelligent asset allocation is compromised by centralized systems. That the bigger the system is, the more the big banks control things, or the more big Fed, big whatever controls things, that the less innovation that you get.
So it sounds like you're making the argument for decentralization.
Of course.
Okay.
I always have been making the argument for decentralization, and what I'm saying is that this is a big step towards centralization this week, is my point.
Sometimes when you play defense because you have to, because regional banks were exposed, and so the big banks and the Fed needed to play defense, that I don't know if that's really what's happening right here. I think if anything, based on like just listening to what you just said, it really makes the case for, I think it makes the opposite case. I'm not just playing devil's advocate here, but as a trader / contrarian, I think the case is for, I can't even make a case for these top tier banks right now. Like, I think if you're rallying up to new highs based on just other places going out of business, it's over. That's your last gasp.
I don't disagree with you in that regard. But let me just take you to this asset allocation discussion, which, going back to our visionaries versus speculators, is, as you know, I was all face deep in biotechnology last week in Boston, so I was receiving a lot of information that I would have never otherwise had.
Okay,
and the only statistic that really stuck in my head was they talked about the total number of dollars allocated to drug development trials based on disease category.
Okay.
And so you have the biggest diseases in the world, cancer and heart attack being the two biggies, and then down the line for whatever. And heart attack actually being the number one disease on earth, right? Or heart disease being the number one disease. But when you look at the asset allocation for drug trials in America right now and over the last 10 years, less than 1% of all drug top trials are for cardiac.
Okay.
Right?
I don't know I don't.
Yeah. So I'm just taking that at face value. Okay. The McKinsey report at this keynote, right? Let's believe some.
Okay. That's fine.
It's small. Whatever it is, it's tiny compared to cancer at 30%, stroke, 20%. Sure. Whatever. The point was that how can the biggest disease in the world have such a tiny allocation of the total drug trial development dollars, whether it's Pfizer and Merck or VCs and San Diego, whoever's doing whatever they're doing? And the reason is that cardiac trials are really expensive. They take a really long time, and they historically haven't worked. So you can spend $500 million over 10 years trying to do a cardiac drug, lose the $500 million, lose the 10 years, and end up with a goose egg. Or you can spend that same $500 million on a bunch of other things, from cancer and stroke down to, whatever, lesser, Viagra or skin, whatever coloring. And that to me was a glaring example of where clearly heart disease is an issue for humanity. Clearly, resources are warranted to do it. Clearly, the science is there to impact it. But the asset allocation model tells you don't finance those deals because of the risk, reward, and duration. And at the same time, you have crowding into 50 startups in the same domain. And this is not just biotech. This is normal tech. And
I don't understand your point. Where are you going with this?
That because the incentives from the speculator standpoint are based on probability of success and duration, time to return, as the two core principles, that we end up with massively misallocated investment resources, and that we prevent innovation. And that regional banks or decentralized investment is more likely to take more diverse risk, and that more centralized asset managers, whether it's on the VC and private equity side or on the banking side, are more likely to play me too in terms of repeating the same startups and the same companies. Everybody's doing a fintech. Everybody's doing Uber for food, Uber for...
But efficient market theory would argue that argument has no basis. Efficient market theorists like me would say that argument doesn't carry any weight, because it's not the person that decides how they want to spend their money, okay, doesn't have to spend the money in a way that you feel it should be allocated. Just because you feel that. The person that's spending the money is spending the money based on what they think they're going to, what market returns they think they're going to get. Yeah.
Sure.
So that's the beauty of efficient market theory. The reason they spend 1% on heart disease and cardiac and 30% on erectile dysfunction or whatever is because they feel like, okay, that's how I should spend the money risk return wise.
Absolutely. And so I'm curious. So where does the value of human life figure? In other words, so you're saying they're asking you're a world that's overcome with heart disease and shortened lifespans. I'm not suggesting that you have a moral position like this, but the consequence of what you're describing is widespread heart disease, shorter life expectancies, and extremely high healthcare costs dealing with cardiac interventions, because most cardiac events don't result in death.
Yeah.
Well, all of those costs are not factored into the risk return for asset allocation.
Yeah, because so you're asked. There's two different questions here. The first, which I get, but what you really need to be doing is asking the people. So, who loses the most on? Let's say cardiac is number one, okay, and there's no money going after, but somebody pays for that. If somebody's paying the bill, so is it just all the giant insurance companies? Okay, fine. Then why aren't they financing it? Okay, because
I agree with that.
But because that's the answer. So if you're Blue Cross Blue Shield, I'm just picking them name because we happen to use Blue Cross Blue Shield. If you're Blue Cross Blue Shield or anybody else, okay, and cardiac is your number one liability,
right,
or expense, then go finance. However many billions and billions of dollars because that's where you get the best return. But that is what efficient markets are all about. You can't ask somebody that's in that like
San Diego VC.
Exactly.
Right.
Exactly. Okay, that's the answer though.
Right, but what I'm suggesting is that the structure, if the structure has integrity, I would argue
but this is capitalism. That's free market capital.
I wish it was capitalism, but it's not. But that's because I have all these special dispensations in either tax status or pricing status.
I don't know.
Capital status. The big banks have special status. The private health insurance companies have a special monopoly exemption. So it's maybe a free market for you and me and Bob and Joe and Jane and Sally, but it's sure as heck not a free market for the big insurance companies or the big banks who have either whether the insurance companies have their monopoly exemptions.
You know what's funny is that for the last 24 years of my life, I've been competing in a space where everybody said the same thing that you just said, which the stuff that you just said about competition and unfair, everything else was the same thing that everybody told us when we got into the financial service space. Tom, the game is absolutely rigged. You cannot compete against any of these big firms. They have more money than you, tons more money. They have more resources. They have more connections. They have more advantages, both tax-wise, both politically, everything else. They have regulatory advantages. They have everything else. You're never
capital.
Tons of capital, access to capital. They're going to squash you competitively. They're just going to beat your rates and everything else. And you know what? Like any good entrepreneur would just say, hey, you know what? Good, let them try. I'm trying anyway. And you know what? We kept doing it. And that's not like, we're not the only ones. People have done that for centuries. That's the beautiful thing about, again, that's free market capitalism at best.
I wish that was true. I guess
But Dylan, it is true. That's the beauty of this country. That is true. I mean, I know you're going to sit there and shake your head and go, well, not everybody can be a cable company. Not everybody can be an insurance company. Not everybody can be a bank, but they can. But they can. They can. Not everybody wants to do that. And again, it does, there's a lot of work involved and there's a lot of this and that. But I'm telling you, I don't like the argument that, hey, everything's stacked against me. Everybody's out to kill me. Everybody's out to get me. The allocations aren't fair. They have too many advantages. The reason and I can only speak for ourselves, the reason that we've been successful years is because everybody always said that about these big companies, and they are so big and dumb and stupid and clueless about the industry and fat and lazy that, you know what? There's tons of advantages out there. I would love to build a bank and go after JP Morgan. I would love to. I just don't have the time in my life.
That's simply not true because
I swear to God, I'd love to.
First of all, you have a bank right now. If you wanted to go into commercial banking, you could.
It's not as easy. I just don't have the resources. I don't have the personal I don't have the personal bandwidth. But would I love to go after JP Morgan? Like, I had to choose. Do I want to go after JP Morgan, or, which I didn't, wasn't my area of expertise, or do I want to go after Schwab and E-Trade and TD? And I chose those guys because that's my area of expertise. But if I was in a different business, sure, I'd go after those guys. You don't think I'd want to go after Wells Fargo? I can build what they have 50 times better in a couple of years, and probably disrupt their whole, everything they have. But I just didn't have a little time in my life. But my point is, so that stuff, I don't buy that whole argument. So I just don't think it's real.
I understand, but that's just Tom Salzoff's opinion.
Of course, that is my opinion.
We moved towards more consolidated resources this week, factually. The consequence of that is to be debated, but
we moved because they had to. Now, can I just say, in a different world, if this was 3 months ago and JP Morgan had made a bid for First Republic, it would have been shut down.
Of course.
100%. They never would have gotten approval. Never. Okay. But in times of crisis, okay, and in fairness,
they bought Bear Stearns for $2. I mean, Jamie's the master of opportunistic asset accumulation where all the rules are broken.
Well, anybody could have bought First Republic, or tried to, if they had $30 billion lying around. And also, I don't even know if it's a good trade. The crazy thing about First Republic, and where's JP Morgan now? The same price it was when they announced the deal. But here's the whole thing. First Republic had $89 billion left in assets, and they had $30 billion in liabilities. That's the worst trade ever. I'm not kidding. Like, when I saw that trade, you're sitting there saying PNC backed away. I mean, PNC didn't have a chance. It was unfair and all this kind of crap. I say they backed away. I say they didn't even want it. Nobody else wanted it. This was a crap deal. $89 billion in assets to pay $30 billion for whatever they did. I don't even think it was a good deal. I think they're choking on it.
No, that's a different discussion anyway.
I know, but you're just assuming it was a good deal.
No, I'm assuming that it's centralized asset control, whether it's a good or bad deal, and that centralized asset control basically diminishes the quality of asset allocation, diminishes the quality of innovation, diminishes the aggregate prosperity,
Does it really diminish innovation? Does it really diminish prosperity? No, they just cleaned up a mess. There was a mess out there. Somebody had to clean it up. Does it really do any of those other things? I don't think so. In fact, if anything, I think this is going to hurt. Anytime you take somebody else's garbage in,
it's your garbage.
It becomes your garbage, and garbage in is so hard to get rid of. Like, you just can't get rid of it. It's just a crappy asset. I've never seen anybody like taking an asset like that and turn it into anything worthwhile. The first thing I did when JP Morgan opened the other day was shorted the stock, because I'm like, this is a joke. Like, this is an absolute joke. There's no way this is a good trade.
You also hate JP Morgan.
No, I mean, I'm a customer. Reluctantly.
Exactly. Emphasis on reluctantly. Okay, enough.
Okay, enough.
The Fed's done.
It's done. They put a fork in them.
Is there any implication? Is there any relevant implication to the completion of the hiking cycle?
It's done.
But does that matter anywhere?
No.
Either volatility, whether
no.
Primarily because the fact that it's done was anticipated, for the last 3 months.
Yes, it's over. It's over, Johnny. It's all done. This is the end of this. This is the end of but bonds have already rallied, 8 points off their lows from earlier this year. They were 124, they're 132. I mean, it's already priced in. I mean, the Fed, we beat this to death over the last year, but the Fed doesn't have to do anything. They just have to follow the bond prices. And the bonds have already told you the next move by the Fed is to lower rates. And I think they have a couple of I think they're going to get to a range, maybe, like 100 basis points lower than this in another year, and we're just going to sit there for a while. I don't think rates are going back down into the crapper. I think they're going to sit, in that 3 to 4%. It's the perfect range. Everybody wants everybody wants some interest rate. There's nothing worse than zero, and nobody wants 5, 6, 7. I think you're going to find rates are going to be they're going to find a zone right in this range, and we're going to sit there for a couple of years.
Moving on.
Okay.
Odd alliance between Alexandria Ocasio-Cortez,
Yes,
and Matt Gaetz.
I have a lot to say about this.
It's a New York, Florida alliance against, or in favor of, in favor of banning stock trading by members of Congress.
Yes.
Which I would think is politically a layup. I don't know who in America, as in the general population, would be against that.
Well, if those two can get together, the answer is yeah.
That's what I'm saying. Like, if you have those two, I'm assuming you're going to say it doesn't matter.
I'm not going to say it doesn't matter. I'm going to say it's horrible.
Wow. Okay. So Carrie,
I'm not going to say it doesn't matter. I'm going to say it's absolutely disgusting and horrible. And I'm going to tell you why.
Wow.
You're
horrified. You're horrified.
I'm horrified by it.
Wow.
Because tonight, when I go to watch New Jersey play against Carolina in the Stanley Cup hockey games, tonight, the playoffs.
You're not watching 76ers Celtics?
Or I'll watch, let me do the hockey first. When I go to watch that hockey game, you better damn well have an ex-hockey player calling the game. Like, you better have somebody, I want to listen.
Gretzky in the booth,
Well, I don't care if it's Wayne Gretzky, but I'd like to hear an Eddie Olczyk or somebody that's been on the ice. Everybody has. They're going to have an old goalie. They're going to have 2 old defensemen. They're going to have who's ever calling that game is going to have played hockey and played in the Stanley Cup, and who's ever doing that basketball game tonight, they're going to have played basketball in the NBA. I do not.
Shaquille O'Neal calls it G14 certified. He's like, you shouldn't be allowed to comment on professional sports if you're not G14 certified.
He's exactly right. And that's why.
But he says he's G96, by the way.
Okay, whatever he is, I'll believe him. I love it. But my point is, he's absolutely right. And I do not want, and so I'm going to take that same argument, okay, and take it to Washington. I do not want a bunch of crazy ass idiot politicians on both sides of the aisle who have never made a trade making decisions about the stuff that I do, that I understand, and the things that I built my life around and work so hard for. I don't want people making decisions when they have no clue as to what they're doing. I personally couldn't care less. I don't even care about, there's no such thing to me as material, non-public information that can affect, that they know what's going to happen next in any
preposterous.
Any level of government. Okay, if you're asking me if the CEO of IBM should be able to trade IBM stock prior to them making a deal, the answer is of course not. I'm not suggesting that.
You're saying material non-public information does not exist. You're saying it's not in the domain of government.
Of course, material non-public information exists. And it exists inside of a boardroom. It exists inside of an executive committee of every publicly traded company. Okay? It remains the way it is now. You can't say a word. But as far as members of Congress go, I couldn't care less. There's nothing. You could have told me today.
Congress is could change healthcare legislation in a way that eliminates the monopoly exemption for healthcare, or is going to change banking legislation to enforce the 10%.
It doesn't mean a damn thing. Yes. Come on, Dylan. If I'd said to you today, hey, you know what? Jay Powell's going to tell you 3 hours before the Fed comes out, and they're going to. It's not totally different. It's the same crap.
If I'm going to break up J.P. Morgan, you don't think that's a material non-public information?
Okay, let's just use it as an example. You're going to break up J.P. Morgan. Is that good or bad for the stock price? If you're asking me right now, and I was the only person in the world that knew you were going to break up JP Morgan, and I've been trading my entire life, I don't know if that means the stock's going higher or lower. At first, I would say
that's nothing more than suggesting that I gave you a bad example. That doesn't mean that there's no.
Give me a good example.
Okay, I'm going to eliminate the monopoly exemption for health insurance companies.
Okay,
that will for sure cause private health insurance companies to go down in value. They're built on the monopoly exemption.
Good. You would have to search. I don't even know if that's the case. And that
Or energy policy. I mean, transportation policy. I mean, subsidies for electric.
Let's talk energy policy, because I love when people bring up energy policy. So recently, Saudi Arabia announced that they were going to cut production. Okay. And so they announced they were going to cut production, and oil jumped up a couple of bucks. And now it's 3 weeks later, it's $17 lower. Okay. So who would have thought? You have no idea. Nobody has any idea. For the few times...
Your suggestion that government has no material non-public information, it doesn't make sense.
My suggestion is that the material non-public information the government has no value. And for the one or two times that you may be able to put it in some bucket of value, the reality is it doesn't really have any. More times you're going to lose than make. And on top of that, the value is off. Whatever that costs us from somebody guessing right once, the value of what this means to structured financial markets and market structure itself is so much more valuable that these people actually trade and understand market structure than it is not having them participate.
No, I understand your point. I disagree with you.
So Tony Romo's calling a game now you can bet on every play basically through, DraftKings and FanDuel and everything else. And it's about to be on your computer that you're going to be able to bet, literally 1 second before the play is called what the next play is going to be. So Tony Romo's on there. He's played for, he's an all-pro quarterback who says, you know what, based on this lineup, the next play, they're going to pitch the ball out to the right. He's going to run off tackle to the right side. Okay. So everybody clicks in really fast and does that. Okay. That's material non-public information, I guess.
Or material non-public information would be if you knew the play call.
Okay, fine. So let's say you know the play call. You can read their signals or whatever it is. Okay. It doesn't matter. You don't know what they're going to do. Okay, it doesn't, everything will...
When there's a new $5 or $10 or $20 billion subsidy for a semiconductor factory in Texas, that politicians...
Okay. So we play in a $50 trillion playing field. The playing field that I live in is $50 trillion. Trillion.
Okay, that's an aggregate. That's just
I understand. It's an aggregate number. It's a $50 trillion playing field. And you're worrying about a few $100,000 or a few $1 million that may get exploited. But most of the time, they'll be losers. More times than not, they'll be losers than winners. And the offset of that is that nobody has any experience or know-how whatsoever.
Other than the fact that, as it is right now, the rules already reflect no experience or know-how. In other words, it says, if I were to take your argument, which is, listen, let them take a shot, even if they make a couple of bucks, whatever.
Sure.
With that, the value of them understanding the markets is far more valuable than whatever the advantage or disadvantage of a given congressperson's trade may be.
Exactly.
But then that would suggest that actual market regulations are logical and rational, which they are not. Because right now they can trade, and they are able to do what you're describing, and the market regulations are horrendous.
No, the market regulations.
I mean, your own notes are like
their market regulations.
$5,000 cap, the margin thing.
But those are regulatory. The regulators can't trade, so that's a whole nother issue. So, like, here's an example. So, if you go to work, if you took a job tomorrow with Goldman Sachs or J.P. Morgan or whatever it is, Dylan Radigan can't trade anymore.
I had that role when I worked at CNBC, by the way.
Perfect. At CNBC is another great example. So do I really want my hosts at CNBC that are talking about markets all day, but they can't make a trade?
Terrible.
Of course, it's idiotic. It's idiotic. So I sit here.
It's for the marketing department to market the illusion.
I got it. But everybody, the reason people watch Tasty is because we do trade.
Of course.
And we tell, this is what we're doing. My point is, that's the same damn thing. Do you think we have any advantage, non-public advantage here? You know what I'm saying?
So then they would argue the AOC Matt Gaetz thing is the same thing as the CNBC thing, which is the artificial appearance of integrity, which is actually reducing the skill set of the.
That's my argument.
And they're still corrupt. It's not like to whatever degree they were corrupt before there was a stock ban, they're equally corrupt thereafter.
It's not even the corruption piece doesn't bother me. It's the incompetence piece. It's the lack of know-how. The corruption part, you can't do, if you elect politicians that lie, that are unethical, then that's on us as constituents, or that's on the constituents, or whatever else it is. There's not, if we elect people that aren't trustworthy, that aren't honest, that's on the voters most of the time. I mean, sometimes they get duped, like with what's his face, George Santos or whatever it is. They get duped, and because he just flat out lies or creates a story. But for the most part, most politicians, you got to know. I mean, you should be able to figure it out. I'm sorry, but
that's for another day. I mean, because we have another massive disagreement, because ultimately voters are limited to the choices they're given, and the choices they're given are entirely controlled by a very corrupt and small group of people. That's why you're going to have Trump versus Biden next year, and nobody wants Trump and nobody wants Biden, and the entire country would do anything to have 3 good choices for the Democratic side, 3 good choices for the Republican side, no Trump, no Biden. 80% of the country would say yes. And yet there's a 90% chance you're going to be looking at Trump Biden. Anyway.
Let's hope not.
You see this Carl Icahn news? Hindenburg going after Carl Icahn?
I did see that. I saw that Carl Icahn stock was down about $7 earlier today. It's IEP. I traded it for the first time this morning. It's down $7 right now. It's the first time I ever made a trade in there. I sold the 2540 strangle. I kept my position really small, and I just
as if basically you're selling a vol without a directional.
Yeah, and right now I'm down 40 cents, so it's going against me. But I've never. The only things, I don't know anything about Carl Icahn except whatever you told me.
Yeah,
because you've been talking.
What's more interesting to me is Hindenburg, to me, which was the same firm that went after, I forget the man's name, but it was some gojillionaire in India.
Well, they went after him, but they've gone after like Bill Ackman. They've gone after a bunch of people.
Exactly. Yeah. And so I'm more interested in when you look at an organization like Hindenburg that spends obviously a lot of time and money, more or less creating well-researched and well-presented slide decks that they then issue as a premise against whatever or for whatever. Is that helpful? Is that is that a useful act?
Well, the funny thing about this is that, there are certain people that, Carl Icahn's an interesting target, because if I remember correctly, and I may be off on this one, but, and I may have the parties wrong, but I could have sworn that Carl Icahn jumped on their side when they went after Ackman.
Technically, because Bill and Carl have always hated each other, so that would make sense.
And I thought he jumped on the short side of that trade back whenever. No, he jumped on, what was the name of that company that
Herbalife.
Right. And so what he did is he
bought it.
Ackman went short it. So it must not have been Hindenburg then, it was somebody else. But Ackman went short it, and then Carl Icahn went in and bought it. But Icahn's he's a tough old codger. He's...
Well, the thing that I saw when I said, because I've had a lot of reporting experience with him and have an appreciation for his personality as sort of a, he's the ultimate sort of legend of New York, and with
sure,
the tough old codger. I mean, this guy, he's anyway, we don't have to, but Hindenburg's giving him a little bit of it. Hindenburg is giving him a little bit of his own medicine.
Yeah, they are. Yeah.
Because Carl spent decades being like, this is bullshit. This company's bullshit. You're bullshit. You're fired. I need a board seat. This whole thing's a fraud. Go home. And now I find, sort of there's a cosmic, to see someone do that to him is entertaining, if nothing else.
It's going to be interesting to see how this, I put a position on here today only because I kind of wanted to follow it. Icahns, well, I don't know how old he is. He's got to be close to 90 now, but he's still going to go out. He's going to go down swinging.
I mean, his coherency is off the chain. I mean, his age is almost irrelevant. I mean, I would take a Carl Icahn decision at 99 years old over the average 45-year-old.
No. Like I said, he's going to go down swinging if he does. And I'm guessing that this is, I would have a hard time. It would shake my it would shake my confidence a little bit in the system. If Carl Icahn's a fraud, it would really bother me. It really just...
I was talking to Josh earlier about this very thing, which is, imagine if Carl turns out to be in on some structures of some... The Hindenburg accusation is new money's funding old money, old investments in a Ponzi-like way.
Yeah.
New money's flowing in, stops flowing in, the ability to cover distributions goes away.
Yeah, it's interesting. I
think it would be more devastating than Bernie Madoff were it to be true, which hopefully it's not.
I don't follow... Well, the difference between Bernie Madoff and Carl Icahn is that Carl Icahn owns publicly traded companies. I mean, it's not air. Bernie Madoff made the whole thing up. There was no company. There was no stocks. There was nothing.
Incredible.
It was a spreadsheet, and he took all the money. He pulled the FTX thing. Just the whole thing was made up. There was nothing there.
He was like the guy that bought the New York Islanders.
Yeah, sure.
Yeah.
I mean, those are 100% fraud. I mean, Carl Icahn actually buys these companies. They're actually companies in his portfolio. I mean, it's not
actual board seats.
Yeah, I mean, they're real companies, and they own the stock, and he's a shareholder, and he's on the, he's listed at, his ownership is disclosed. So it's not a fraud like that. I mean, maybe he hasn't made the return that I don't know, that people think he's made or something like that, but it's not a box of air.
Well, at the very least, Carl, let me put it this way. I'll leave as an indication of Carl Icahn's character. This is, 15 years ago or something. There was some law firm that had done some engagement letter with Icahn, and Icahn Enterprises, probably not Carl, but the company in some way. And then there was a dispute about the billing with this law firm, and it was like a $200,000 legal bill, or God knows what. And Carl was of the opinion that the law firm didn't deserve the money, they didn't do the work. Whatever the scope was, they didn't deliver the work. And so went to court in New York City to like the civil, trial, whatever. And Carl Icahn took time out of his day to get in a car and go down to the courthouse and testify as to why it was that this law firm had not done the $200,000 worth of legal services. And no one could believe it, because here's this person with billions and billions of dollars and all these other theoretically more valuable uses of his time. My point is, he will go to the mat with Hindenburg.
Oh yeah,
he will have his own slide deck.
Yeah,
soon enough, and
yeah, no question.
You have to respect the audacity of Hindenburg to take a shot.
Yeah,
and so it's a ballsy move.
What's the old saying? You come at the king, you
better win. You better kill him, whatever. Yeah,
you better take him out.
And it's one thing to go at the king in India when you're in New York, because so you have some jurisdictional protection. It's another thing to go at the king of New York from New York.
I'm Tom Sosnoff. He's Dylan Radigan. We went long today. Sorry about that. Dylan, good stuff as always. I will see you next Wednesday.